Dear students, welcome to the second class of financial accounting. In the last class, we had closed on the importance of accounting. Let us do a quick snapshot of what we discussed in the last class. We had covered the meaning of accounting, we had covered the purposes of accounting, we had covered the users of accounting, as well as we talked about importance of financial accounting to relevant users of accounting data. In this class, we will start with a topic that what are the limitations of financial accounting. Dear students, financial accounting is also a field which is not away from limitations. Everything that we discuss in the world had certain advantages and disadvantages, and so does financial accounting. Talking about the disadvantages or limitations of accounting, the first limitation of the accounting is that it is based on accounting concepts and conventions. Now, what are concepts and conventions? Concepts and conventions are certain rules, principles and way of preparing the accounts. When you have to follow systematic way of recording, when you have to follow systematic way of classifying, interpreting the results, you have to stick to the formats, you have to stick to the rules, regulations, and that becomes one of the most important limitation for an accountant, that he has to follow the concepts, he has to follow the conventions in making the accounts. That is the first and foremost limitation, and we have to be careful when we are making accounts with this limitation. The second limitation is that accounting will not give answers to all the problems. The managers, the accountants, they will be able to see the accounting data, the accounting information in a certain format. The decision making has to be ultimately done by the managers. The managers has to see whether the company is going in a positive direction or a negative direction. Financial accounting would only tell you the results of the company in terms of profit or loss. It will tell you that what are the assets, what are the liabilities. It will not tell you what to do about the business in the future. That decision has to be taken by the managers only. So, accounting only gives you certain data set, it certainly gives you evidences, but it does not give you solutions to your problems that managers have to do. This is the second important relevant limitation of accounting. The third one here is that there can be omission of a qualitative information. Dear students, if you can recall, in the last class we had talked about an example where managers had a fight in office. Now, when you cannot record such kind of an information in accounts, when you cannot put qualitative information in accounts, certainly you will not come to know about these information from accounting sets. So, when you are not coming to know that what is the qualitative information in the financial accounting set, this omission of information from financial accounting information will not be fulfilled from your statements. So, this is an important and relevant limitation, and we have to be careful while we are taking decisions on qualitative aspects, because accounting will not help you in qualitative informations. Another limitation is that it is based on historical costs. Now, what is the meaning of historical cost? It means that suppose you has bought a land 20 years ago. So, when you purchased the land 20 years ago, maybe the value of that land was 2 crores. When the value of that land was 2 crores 20 crores back, the accounting information will give you that old set of information. You will not come to know from accounts what is the market value of that land. Certainly, the adjustments will be made to the value of the land in the books of accounts, but the market value of that land will have to be fetched by on your own. Accounting will not tell you the market value based on historical costs. This is a very, very important limitation, and accountants cannot do anything about this limitation. Another is that you will not be able to produce, predict, forecast a data on accounting information, meaning that the financial statements of the company will only tell you that whether you made a profit or a loss. They will only tell you what are the assets, what are the liabilities of the company. They will not tell you on your own that what is the next step ahead. That will have to be done by managers or certain professionals, wherein the future may be predicted based on the past data. Accounting will only tell you that what has happened in the past. They will not predict, they will not forecast. So, to know the forecast, you will have to do certain analysis, you will have to use certain models to further predict that what will happen based on the previous data, but accounting will not be able to tell you that. So, that is one of the biggest limitation of financial accounting records. So, this was about limitations of accounting. Now, let us move forward to basic accounting terms. To understand the advanced level of accountings, first of all we should know that what are the basic accounting terms which are used in the financial statements of a company. Like for example, if I talk about the first one here, it is called as assets. I told about assets in the earlier class also, that assets refer to the resources of the company. Assets may be classified into two types, tangible or intangible, based on their reality. When we talk about tangible assets, examples could be building, examples could be furniture, machinery, etc. When we talk about intangible assets, examples could be copyrights, trademarks, goodwill, etc. Assets will be something which are owned by the enterprise and they are capable of giving you certain returns, certain profits in the future. So, assets will be something which is stored in the business to produce income, to get some profits from them. So, they are the resources of the company, which can also be classified into two categories based on the time period for which you are holding them. They can be called as short term assets, they can be called as long term assets. When we say short term assets would be something which you hold in the business for less than 1 year. When we say long term asset could be something which you hold in the business for more than 1 year. So, assets can be classified into short term and long term based on the time period for which you are holding them. Further, if we talk about the detailed classification of the assets, they can also be classified as fixed assets, current assets and liquid assets and fictitious asset and wasting assets. Now, these are certain important terms related to assets which we should know before we begin to understand how do we make the statements of accounting for a company. If I talk about the first classification, which is called as fixed asset, it is nothing but those assets which are also called as long term assets. These fixed assets will remain in your business for a longer period of time. For example, as I said earlier, it could be land, it could be building, it could be furniture, it could be machinery, etc. Moving on to the second category, it is called as current assets. Now, we talk about current assets as the short term assets. Current assets or short term assets would mean one and the same thing. If we talk about current assets, examples could be if there are any debtors in your business from whom you have to take the money, it could be your bank balance, it could be your cash balance, all these are examples of current assets. The third category here is called as liquid assets. Now, when we talk about liquid assets, from liquid assets you can derive them from the current assets by subtracting the stock and the prepaid expenses. The liquid assets will be those assets which can be readily converted into cash faster than the current assets. The fourth one here is called as fictitious asset. Now, when we talk about a fictitious asset, it does not mean that it is not your asset. It is certainly your asset, but it will be those assets which will be deriving the value from a longer period of time. For example, if we talk about preliminary expenses, these are your assets which will be converted into benefits after a particular period of time. To tell you here what are preliminary expenses, preliminary expenses are those expenses which a business will be doing when they start their business. So, fictitious assets will help you in the future for deriving benefits, but currently there will be no benefit, they will be only incurred. The next asset here is wasting asset. When we talk about wasting asset, it will be a category of those assets which you produce, which you actually buy, purchase, and then it is sold off. And when it is talking about a sold off, it is no remaining value. No remaining value means something like gas, oil, which you had as an asset, you have procured it, you have used it, and maybe you used it and it went off, it is finished. So, that is a wasting asset. So, these are the basic accounting terms related to the assets which you should know before we prepare the financial statements. Talking about the basic accounting terms further, let us talk about important aspect as a terminology which is called as liabilities. Now, when I talk about liabilities here, the liabilities also could be classified into two types in terms of time period like we do for assets. Liabilities could be short term, liabilities could be long term. When I say a short term liability would be something which is related to a time period less than 1 year. Now, when I say less than 1 year, it means that these liabilities will be met off, these liabilities will be paid off within one financial year. They are called as short term liabilities, or they can also be called as your current liability. When I talk about long term liability is also called as your fixed liability. For example, share capital, for example, a bank loan for 15 years, for example, debentures issued for 10 years, all these are your long term liabilities. So, liabilities are basically those headaches from the business which you have to set off, which you have to pay off depending upon the time period given to you in the business. So, these basic accounting terms are certainly important when you want to start preparing financial statements. You should know the concepts, you should know the meaning of these terms very clearly. Next is other important terms which could be relevant from the point of view of making accounts. For example, the first one here is called as capital. What is capital? Capital is that amount of money or any resource which is brought into the business and has been invested in the company for a basic purpose of earning returns, getting returns from your investment. This capital could be long term capital, this capital could be short term capital, this capital could be also fluctuating capital. When I talk about long term capital or fixed capital, this capital would be fixed, meaning that you will certainly have this as a fixed capital irrespective of your business operations. When I talk about the capital which is called as short term capital or working capital, it will be that capital which will vary depending upon the requirements of your operations, depending upon the requirements of your business. This short term capital will keep on changing as per the requirements, as per the seasonality of your business. There can also be a circulating capital which may increase at the time of peak demand in your company. So, this capital will be helping you to earn returns on the investment you have made in the form of capital. The next important aspect is called as a contingent asset. It is a rule in accounting that you cannot put anything in the books of accounts which is still not your asset. So, in other words, there is nothing like contingent asset which can be put into the business of books. But if you talk about contingent liability will have to be shown as a footnote in your balance sheet. Now, what is the difference between a contingent asset and a contingent liability? Contingent liability is something that can happen in future and you must report it to your users as a footnote. Contingent asset is something which can be your asset in the future, but you will not put it in your books of accounts until and unless it has become your asset. So, that is the basic difference between a contingent asset and a contingent liability. Moving on to the next term, which is called as provision. Now, when I say a provision, this provision comes from a concept in accounting which we will be discussing in the upcoming classes. Provision is something which accountant says that I should keep as a precaution if something bad happens in my business tomorrow. So, this provision is kept as a side, as a cushion for maintaining the smoothness in the business. This is called as provision. The next one is transaction and event. Now, to understand the transaction and events in details, we will take certain examples here, but before that let us understand what an accounting transaction is. If we recall the previous classes, we had discussed this thing that whatever can be valued, can be measured in terms of money will only go to the books of accounts. Now, whatever is measured in terms of books of accounts is measured in terms of money will go into the books of accounts means that first of all you identify the financial nature of the transaction, and if that financial nature of the transaction is in terms of money, if there is a finance involved, if there is a money involved, only then it is eligible to enter the books of accounts. So, a transaction, a accounting transaction would be something wherein some kind of an exchange has happened. Suppose you made a sale, for example. If you have made a sale, for example, you would be either receiving the money from the other person to whom you have sold the goods, or there will be a liability on that person to make you payment. So, he will either make the payment today or he will make the payment tomorrow or maybe after 6 months, but the accounting transaction has occurred today itself. Moving on to event. Event will be the output of a transaction. Let us say you have purchased a land and building today. Purchasing a land and building today would mean that you may be making a payment today or you may make a payment after 1 year of time. So, when that happens, the transaction will be that you have purchased the building today from the other person, and if suppose you made a payment through check, that will also be entered into books of accounts. But if you did not make the payment today and you make the payment after 1 year, that after 1 year will be another transaction. Buying of the building on credit will be another transaction. So, you have to be careful in identifying the transactions like this. When you want to make financial statements, when you want to prepare books of accounts, you must identify the nature of the transaction and the output, that is the events which are taking place after the happening of those transactions. If you are able to identify transaction and event separately, if you are able to identify that this is the accounting transaction and these are the outputs of the transaction, you will be able to manage the transactions, their recording, their interpretation very easily. So, now for transaction and events, let us try to understand it with an example. Now, when I talk about an example of a transaction or an example of an event, let's suppose take an example. There is a person whose name is A. This person starts a business with a capital of 1 lakh rupees. Now, with that business of 1 lakh of capital of the business, this person would like to see that where is this 1 lakh going. That is one thing. Another thing is that if the transaction has happened by starting a business with 1 lakh rupees, the question is it a transaction? Will it go to the books of accounts? The answer is yes, it will go to the books of accounts because there has been a to and fro of money in this transaction. Now, you have to identify two things. Number one, whether it is a transaction. Number two, whether there is an event which is happening in this transaction. So, transaction will be an exchange if it has happened. Event will be the output of that transaction. For example, in this case, A is a person who has started the business with a capital of 1 lakh. So what has happened in this example? A is a person and he has put certain money in the business, and that money value is 1 lakh rupees. Now, the capital which has been infused in the business, in this case 1 lakh rupees, is certainly measurable in terms of money, and if it is measurable in terms of money, it is eligible to enter the books of accounts. So meaning that when you want to record a transaction, you must first identify that whether it is a transaction or not. If it is a transaction, should it go to the books of accounts or not? And the transaction which has got a money value will only be going to the books of accounts. Second thing that you must identify should be that what are the events of these transactions. Like for example, if we talk about this capital infusion by Mr. A, the capital has been infused in the form of money, so that means the cash balance of the company will increase, and on the other hand the capital of the company will increase. So the transaction will be that there has been an infusion of money into the business, and the event will be that a capital is generated in the business as well as the cash balance has increased for the business. Then the person does some other transactions also with this 1 lakh rupees. Let us try to understand each example here with the point of view of its eligibility to enter the books of accounts. Meaning that whatever transactions Mr. A is doing here, will they enter into books of accounts? That is first question that we should see. And the second thing is, he should identify that what are the outputs, what are the events which are happening because of these transactions. So the first one that we discussed was infusion of the capital into the business. So we said that yes, 1 lakh rupees is capital and 1 lakh rupees on the other hand is cash. Both of them will appear in the books of accounts as number 1 cash, number 2 capital. And what will be the event? Event will be that we have a balance of 1 lakh rupees in cash and 1 lakh rupees in capital. Both of them will appear in the books of accounts. So the transaction in nutshell is infusion of the capital in the business, and the event is that we have a capital and we have a cash from that transaction. Let's see what is Mr. A doing next in this example. Mr. A is making a cash purchase of 80,000 rupees. Now what is the meaning of cash purchase of 80,000 rupees? It means that the amount of money up to 80,000 rupees has been utilized for making purchases by Mr. A. Now if he has made a purchase of 80,000 rupees and it is measurable in terms of money, it will certainly go to the books of accounts of the company. This 80,000 rupees will now generate two things. What are those two things? Number one, the raw material will be purchased or maybe some other purchase will happen, and on the other hand the cash balance will reduce, will decrease. So spending 80,000 rupees would mean that number one, whatever you are purchasing, its balance will increase. Number two, if you are spending cash to purchase that item, your cash balance will decrease. Now, is it a transaction? The answer is yes, it's a transaction. And this accounting transaction, is it capable of getting into books of accounts? The answer is yes, it is capable of getting into books of accounts because it is measurable in terms of money. Now, if it is measurable in terms of money, are there any events generated from this transaction? The answer is yes, the events have been generated in two ways. What are the events generated in two ways? Number one, you have purchased raw material. Number two, you have decreased the cash balance. So the event will be the cash balance and the material balance, and the transaction will be buying, purchasing from that cash. So this is the example of second transaction in this case. Let's move on to another example. We have a cash sale of 90,000 rupees. Now when we have a cash sale of 90,000 rupees, what will happen? Whenever you make a sale for cash, the transaction is recorded in terms of money. Is it a transaction? Yes, again it is a transaction. How? This 90,000 rupees of cash is received in the business, and for this 90,000 rupees of cash you have given certain goods to that person who has made the purchase from you. So, when you make a cash sale of 90,000 rupees, certainly you generate cash for the business and you give in return goods to that person for buying it for 90,000 rupees. So, is it an accounting transaction? Yes, it is an accounting transaction, and the events that will be generated from this transaction will be that your cash balance will increase by 90,000, and on the other hand the goods, the inventory, the stock will be reduced by 90,000 rupees. So, every transaction that you will see in accounting perspective will have a twofold effect, meaning that if something is coming inside the business, something will also outgo from the business. If there is an inflow in the business, there will be an outflow also in the business. So, it is a to and fro process when we talk about accounting transactions, and the events that are generated from that to and fro process are certainly in terms of output, like we have discussed certain examples here. After the example of a cash sale, let us talk about what was the cost of these products when we talk about. So, if you have made a sale of 90,000 rupees, does it mean that the cost was also the same? For a businessman perspective, the sales value will always be different, the cost will always be different. When we talk about costing of the goods and when we talk about sale of the goods, there is a difference of profit or loss. Suppose you have sold these goods for 90,000 rupees, but what is the cost? How will you calculate the profit? You will go and see that what is the costing of the goods. In this example, our sales value was 90,000, our cost of the goods is 60,000. So, if 60,000 is the cost of the good and sales value is 90,000, will the profit be 90,000 or 60,000? No, the profit will be the difference of these two values. What is the profit margin in this case for the manager, for the salesman? The profit in this case will be 90,000 minus 60,000, meaning that sales value minus cost value. In addition, if there is also a rent of the godown that the person is paying, will that be subtracted or added? What will you do with this rent? This rent of 10,000 rupees is certainly an expense towards generating a sale of 90,000 rupees. So, when a manager, an accountant is calculating its profit or loss, what will he do? He will pick up the value of 90,000, what was the sale of the company, he will subtract all the expenses, all the costs which have been associated with making of this sale. So, the sales value of 90,000 will be the revenue of the company, and the value of cost of the goods, which is 60,000, as well as 10,000, which is the rent of godown in this case. These both 60,000 and 10,000 will be subtracted from 90,000 to calculate what is the real profit in this transaction. Like for example, here your total expenses will be 70,000 and your sales value is 90,000. It means that you have made a profit of 20,000 from this particular transaction. So, now in the end your final output, final event will be profit you have generated, cash balance that you have as pending, then you have the capital pending, and then you have what is the stock which is left over. All these will be called as your events. To be precise, in a technical language, if we say what are the results of these examples, the results are as follows. First of all, you have generated an economic activity. So, that means when you started a business, you have contributed to the economy by starting this business. The second one is that whether there are any transactions. Yes, we have discussed the transactions which were there in this example. Then is, are there any events? Yes, of course, there were events also. So, let us conclude. What is a transaction? Transaction means anything which will have a to and fro in the business. A transaction will be something which is having an exchange of goods and services in the business. A transaction will be if a person has invested capital in the business. A transaction will be if a person has contributed any asset into the business. Now, events will be whatever is the output of those transactions. For example, if the person has invested capital into the business, then the cash will be an output, capital will be an output. If you talk about what is an event in case a cash sale is made, then cash is the output and reducing of the stock is an output. If you say that when you have paid a rent of godown, what is the output, then expense is an output, and certainly the cash balance is reducing, that is also an output. All these transactions and events will have their place in the books of accounts. So, when you are starting to make books of accounts, you must be careful with it that you should analyze that whether it is a transaction or not. If it is a transaction, is it having any money worth or not? If it is having a money worth, that whether I should put it into the books of accounts or not, and by putting it into books of accounts, what are the outputs, what are the events which have been generated is very important to understand, so that we do not go wrong when we are making the books of accounts. Making books of accounts has their own rules, own concepts, own conventions. The regulations which we should follow are important. When we are making the books of accounts, we should understand the transaction, we should understand the event, and very carefully we should decide that whether this transaction should be entered in the books of accounts or not. If we unnecessarily put any kind of information in accounting which is not required, then the true results will not come out for the business. So, it is important to understand transaction and event. This case study of small example that we have discussed here would certainly help you that what is a transaction and what is an event. Now, let us move to some other important terms in the business which are important to understand before we go to concepts and conventions of the business of the accounts. Like there are certain important terms as a jargon, we should know that what is the meaning of these terms. For example, the first one here is called as a revenue. Going back to the previous example of a cash sale, where we said that the cash sale was for 90,000 rupees. That cash sale was an example of a revenue generated. So, the revenue is basically the total sales value for a company which it is selling the goods for. That is called as a sales revenue. We should understand here that there is a difference between revenue and profit. We will come to understand when we go to accounting transactions further that what is the difference between revenue and profit. Moving on to the next aspect, which is called as expenditure. Now, when I say expenditure, expenditure could be a long term expenditure, it could be a routine expenditure, it could be a deferred expenditure. Now, what is the relevance of understanding expenditure here? Expenditure will be any kind of an expense which has to be appraised, which has to be analyzed to find out the profit or loss of a company. For example, you have paid salaries of your managers. If you have paid salaries of your managers, that is a routine expenditure. It will come into day-to-day expenditures of your business. On the other hand, let us say you have invested in a capital project, you are constructing a flyover. Is that a routine expenditure? No, it is not a routine expenditure, it is a capital expenditure. So, this is what expenditures mean in this perspective. The next term here is called as an expense, which belongs to that if there is a certain kind of a benefit to the firm, that will be told as expense, otherwise not. After the term expense, we have the term called as goods. What do we understand by the term goods? If you can recall, I had talked about business operations earlier. Now, when I say goods, goods means in the perspective of business operations. If a company is selling ice creams, the ice creams are the goods. If a company is selling furniture, the furniture is the good. If the company is selling mobile phones are the goods. It means that whatever sales of items are happening by a company, those items will be called as the goods of the company. The next term here is called as debtor. Who is a debtor? Debtor is an important person in the business. The debtor will be that person to whom you have made a sale on credit. When you make a sale on credit, it would mean that that sale has not generated an immediate cash for you, but the other person will make a payment in the future period of time. And the person who has to make the payment to you in the future period of time is called as a debtor. Opposite to the debtor, we will have the person called as creditor. Who will be the person who is called as creditor? Creditor will be a person to whom you have to make the payment and he has given you a credit for certain period of time. So that means you have purchased goods, purchased raw material from the other person today, and you have to make a payment to him in the next 3 months, in the next 6 months. He is a creditor for you, and you have to be careful that you have relevant balance maintained for making a payment to him. Then the next term is bills of exchange. Now when I talk about bills of exchange means that it will be a kind of an invoice, a kind of a document which will tell you that what are the details of the transactions, whether you have made a purchase or you have made a sale. For that purpose, the bill of exchange is generated, that the person who is to pay to you in the future maybe will enter that amount on a particular bill, and that bill will be a document, will be a evidence for that transaction. Moving on to next important terms that we have accounts receivable. Accounts receivable is synonym of a debtor. Accounts receivable will be the same as debtors from whom you have to take the payment. The opposite to this is accounts payable. Accounts payable means a person to whom you have to make a payment. So meaning that accounts payable is synonym of creditor, accounts receivable is synonym of debtor. Moving on to the next term here is called as discount. What is a discount? Sometimes it would happen that when you buy an item from the vendor, he will give you a relaxation in the value of the bill. Now that relaxation which is given by the vendor in buying of a certain item, for example, the value of the item is 100 rupees, but he gives you a discount of 5%. So that is called as a discount. Moving on to the next, which is called as commission. Commission is something which may be earned or may be spent depending upon the transaction. Suppose you are giving a commission to a salesperson for making an extra sale. So that commission, when you are making it as a payment to the salesman, is an expense for you. But if it is vice versa, suppose you are getting a commission to provide some service to your client, that is a earning for you as a commission. So this is what a commission refers to. Next is called as cost of goods sold. Very important term is popularly also called as COGS. When we say cost of goods sold would refer to that amount of cost of particular goods which you have spent to produce them and to make them saleable. So when you have done cost of goods sold, you would like to know that what would be the profit margin on the cost of goods sold. There will be certain amount in which your product in that amount, that product has become saleable. It has become ready for sale. Now that cost will be a basis to fix the profit margin on that particular good. The next aspect here is called as gross profit. When I say gross profit is the difference between sales and cost of goods sold. You can calculate the gross profit by subtracting cost of goods sold from your sales value. The next term here is net profit. Net profit means when you have subtracted all the direct and indirect expenses from your sales value, you will arrive at net profit. It is also called as profit after tax in summation form. For this class, we have these important terms. We have covered certain relevant aspects like what is a transaction, what is an event, what are the limitations of accounting, what are the important terms which you should focus while you are trying to make books of accounts. We will continue with the financial accounting in the next class. Thank you.